Well, we have Neelotpal Sahai, Head of Equities and Fund Manager at HSBC Global Asset Management, who is joining us to take some questions. Neelotpal, great to have you with us here. Thank you very much. So things seem to be, the globe seems to be catching up, or we seem to be catching up with the globe in terms of what's been going on. What is your assessment? The general consensus now seems to be that if there is significant pressure for global equities, the markets here also perhaps will react, cannot remain completely insulated, but relatively speaking to the rest of the world, and that matters little for the viewer watching this because they only invest in India, there will be relative outperformance. For fund managers and the like, you can kind of point out and say, well, relatively we're doing better, but there will be pressure here in absolute sense. Would you agree with that assessment?
Good afternoon to your viewers. Yes, absolutely. What you mentioned in the question is exactly what we are thinking and doing at this point of time. While the key driver for the market right now is the actions being taken by the Fed and other central banks, and the impact is felt not only in their market but all other markets. So India cannot be decoupled from that. In fact, the first order impact would be that of the tightening liquid situation, and as well as because the interest rate differential is also narrowing. So that also means that our attractiveness to attract the foreign currencies also goes down. So that will have negative impact on the market in the short term and create the volatility that you talked about. But you also mentioned about the relative performance, and this is very crucial and critical as compared to the rest of the market. And the key difference which is there for our market with respect to other markets, and as well as our market with respect to our own history, is the strength of our balance sheet for all the three arms of the economy, be it government, be it corporate sector, or be it household. So all the three are in a better position, a stronger balance sheet than what we would have entered into a crisis-like situation in the past, or as compared to other economies. And that is why we are in a much stronger position to withstand this the forex from the outside India related concern that we have got. And also not to forget one more thing is that the corporate sector earnings growth has been robust in the last couple of years. Even in the quarter gone by, there was a hiccup, but a small hiccup as such. And one is hoping and expecting that it does not continue beyond 1 or 2 quarters. And again, we get back into the robust earnings growth trajectory. So those are the two factors: the stronger balance sheet for both government, corporate, and the household, and the relative corporate earnings growth actually makes our market in a much stronger and a better footing as compared to the rest.
Right. Hi, Mr. Sahai. Good speaking to you. Mr. Sahai, we're going to be going into a phase where we get some consolidation at best, maybe get a bit of a drawdown as well. If that seems to be the case, and if India is going to be, doing better than what the globe is going to be doing, how do you approach the domestic themes? Are you looking to add into maybe, the industrial theme, consumption stocks? I think discretionary in the past you were fairly positive as well on. Tell us, how do you approach the market? Which sectors would you be looking to add into?
Yeah, so because our prognosis is that there would be near-term volatility, but hopefully things will ease out after that. So the best way to look at from the portfolio construction point of view is to look beyond this near-term period and look from the 3 to 5 year, that is medium to longer term perspective. And there we see 2 to 3 mega trends playing out. One of them is obviously financial, which is our longest standing positive bet, which has benefited on account of significant improvement in the credit cost. In fact, the best that we have seen in the last 10 years. And recently, even the credit growth has also picked up. So that particular sector is doing pretty well, especially the lending finance business. But I also want to bring in a new mega trend which is playing out, and is manufacturing sector, which has seen sort of big revival in the last, as compared to the last 2-3 years. The utilization levels of the manufacturing sector has gone up. The order books are strong. There are many more destinations in the country where the investment is taking place. The incentive schemes has worked out well for a few sectors. And we also see import substitution happening. Earlier, the buzzword was only China +1, but now one can also add Europe +1 to this thesis, especially given that the high energy cost that we are seeing in the Europe might mean that some of the manufacturing in Europe might be unviable at this point of time. So given this thought process, the way we are looking at the portfolio is to be overweight on these two mega trends. And of course, consumer discretion is one of the sectors that you already pointed out. But apart from that, also domestic material companies. Now it could be chemicals, it could be cement, also, and also selectively in the industrial basket also is that what we are positive on.
Neelotpal, good afternoon. You referred to financials. Financials is a large basket, right? So which part of financials? Because the leadership has been with the corporate banks, SBI and ICICI Bank.
Yeah.
The erstwhile outperformers like HDFC Group, that struggled. And of course, there's NBFCs as well. So which part of financials are you going with?
Okay, the shorter answer is already mentioned, plus some other large private banks that we are more positive on. But now the key stock selection would not be based on the ability to grow faster, but the ability to raise liability faster. Because now we are seeing a decent differential between the credit growth and the deposit growth for most of these banks. So the banks which has got a granular liability franchise, those who have made investment into digital infrastructure and to be able to raise, and those who are expanding their branch network, is where that makes us more positive on. So within the lending financials, we do believe that the large private banks, top 3-4 of them, and a couple of, again, large PSU banks also, which have got a strong distribution and also strong digital infrastructure is where we are more positive on. Incidentally, all these banks also have got high CASA deposit, and that also means that the liability franchise is quite granular, and that means that would not be shifting their the source of the places that they would be investing in. So the liability franchise of these banks remains intact. So basically, the top 5-6 banks that we are more positive on.
Neelotpal, sorry, one of the themes you said is manufacturing, right? Which areas?
So selectively materials, some part of consumer discretionary, and again selectively into industrials.
Okay.
Materials, specifically that of the domestic materials like housing, real estate related, cement, and chemicals, and not so much into the global cyclicals. We are not so positive.
So all three local focused, supplying to the domestic market, not very much.
Absolutely.
Not export focused at all.
No, not global cyclicals. We are not so positive on that. They have seen recent jump up in their earnings on account of the higher energy and commodity prices, but we think that is due for a mean reversal, and that does not make us positive on a medium to longer term perspective on some of these global cyclicals.
When you say building materials, you mean only cement, mostly cement?
Cement and other, there are names in the mid caps and the small caps, basically the utility sector, the tile companies, the pipe companies, the paint companies, and the likes.
You had some small exposures to some mid-cap IT as well in the past. Those stocks have corrected big time. They need to still correct more before it can make you interested again? Or do you think you should start chipping into a couple of them?
Yeah, so our view on technology is relatively more positive as compared to how the market has treated them in the last 6 odd months or so, actually. That is because we believe that their underlying business continues to remain strong. The recent management commentary has also remained quite strong, but the worry seems to be emanating from what could happen next year. Now, given that view, and if that view was to materialize, then the better bet at this point of time would be the larger size IT companies, and not so much the smaller size IT companies. The time for the smaller size IT companies will come when the tailwinds behind in the sector. As of now, there is a chances of the headwind in the sector, so the preference would lie with the larger names in the IT sector right now.
All right, Mr. Sahai, always good speaking to you. Thanks so much for stopping in and giving us your view on the markets.